Over the last few days, a couple of macroeconomic indicators sent jitters down many economists' spine. While the inflation for July came in at a whopping 7.44%, the external trade performance, which is the exports and the import numbers for July 2023, didn't boost much confidence either. So have the global pressures finally started affecting the Indian economy, or are these just factors which were already known? And at a time like this, what is the government's recourse? Well, for one, they are front-loading the capex in the first half of this fiscal year. But let's dive a little deeper to understand this better. In today's episode of the Third Umpire, we look at the recently announced inflation numbers and the export-import data and understand the factors which are affecting them. We also look at the host of initiatives announced by the Government of India to boost growth. You're watching Informed Investor, the Third Umpire, an initiative by ResearchAndRanking. Let's begin. Now, the past year has been quite a rollercoaster ride for India's retail inflation. We've seen some ups and downs, and it's largely been a response to the price fluctuations in the basket of goods and the global forces at play. Now, the latest data from the government revealed a surprising turn of events. The Consumer Price Index, or the CPI-based inflation, spiked to a 15-month high of 7.44% in July 2023. And guess what's driving this surge? High food and vegetable prices. Now, what's really worth noting is that this July CPI reading managed to break through the RBI's upper tolerance limit of 6% for the first time in 5 months. And if that wasn't eyebrow-raising enough, the Consumer Food Price Index, which is the CFPI, joined in on the action, hitting a remarkable hike of 11.51%, a level which has not been seen since October 2020. Now, what's got everyone raising an eyebrow is the fact that the market predictions were already pointing towards a breach of RBI's 6% limit in July, but the actual figure of 7.44% has thrown a curveball that caught almost everyone off guard. Now, Rajasthan and Jharkhand saw inflation soaring to 9.6% and 9.1% respectively, ranking them as the highest amongst the 22 major states in terms of inflation. Meanwhile, 7 other states including Tamil Nadu, Odisha, Uttarakhand, Telangana, Haryana, Uttar Pradesh and Andhra Pradesh clocked inflation rates above 8% for the month of July 2023. So what's the backstory behind the inflation spike? Well, it all revolves around the Consumer Price Index, which measures retail inflation. Now, a significant chunk of the CPI is made up of food items, nearly 40%. Now, in fact, when food prices start climbing, you can bet that retail inflation is also going to follow suit. Now, the rapid ascent can be attributed to a steep surge in vegetable prices, especially tomatoes, over the last month. Now, when compared to the year-ago period, food inflation rose by a staggering 11.51% in the month of July 2023, with vegetables leading the charge with an astounding 37.34% surge. Now, tomatoes alone took the spotlight with an unbelievable rise of 201.54% rise in its prices. Now, taking a closer look, the inflation rates for food and beverages spiked from 4.63% to 10.57%, and the inflation rate for cereals rose from 12.71% in the month of June to 13.04% in the month of July. Now, on the other hand, inflation for the fuel and light segment was more moderate, rising at only 3.67%. Now, the big question on everyone's mind here is, what is the RBI going to do about this? The CPI-based inflation just pushed past the upper limit of RBI's 2 to 6% tolerance band, breaking the streak of 4 consecutive months of being within the band. Now, the RBI's official mandate is to maintain retail inflation at around 4% levels. Now, the central bank had predicted that the retail inflation would reach 6.2% during the July to the September quarter. However, with inflation already at 7.44% in July, attaining that goal appears to be a very challenging task at this point in time. Now, in a typical scenario like this one, the RBI would consider raising the repo rate to tackle inflation. Repo rate, as we all know it, is the interest rate at which the RBI lends to the banks. So, as I was saying, in a typical scenario like this one, the RBI would consider raising the repo rate to tackle inflation. However, their recent move was to keep the repo rate steady at 6.5%. The likelihood of a repo rate hike to overcome this challenge remains low, because the central bank's control over food prices is very limited. Since food prices are the driving force behind the inflation spike, traditional monetary policy tools might not be as effective. On a positive note, core inflation, which excludes volatile components like vegetable and the food prices collectively, has only seen a minor rise. This has led many economists to believe that the current inflationary pressures might be more transitionary in nature. Shifting our focus to the government's perspective on this issue, it's important to note that high inflation can disproportionately affect lower income households, which is a crucial concern, especially given the upcoming elections. Finance Secretary TV Somanathan has pointed out that the government has implemented measures to control inflation, and these measures will continue and potentially intensify if the situation demands it. He emphasized that the importance of adopting a medium-term view in decision-making rather than reacting to solely short-term data would be more helpful. Now, in a recent address on the 77th Independence Day, Prime Minister Narendra Modi ji also touched on the issue, mentioning that the government is actively working to curb inflation and reduce the burden of rising prices on the public. Looking ahead, the progress of the monsoon will be crucial, as any uneven distribution of rainfall could have negative implications for the sowing of kharif crops, potentially worsening the issue of food inflation. Now, while we've spoken about rising inflation, which is definitely high, but also transitionary in nature, let's look at another macro indicator which is raising eyebrows for its subpar performance. In July, India experienced yet another month of weak external trade performance. Merchandise exports fell to a 9-month low of $32.25 billion in July, a decline of almost 16%. Additionally, goods imports also fell by 17% to $52.9 billion. Now, in the first 4 months of the financial year, which is the April to July period, exports and imports have now contracted by 14.5% and 13.8% respectively. As for the causes behind this concerning downward trend, it's not just about the fluctuations in commodity prices. Even non-oil exports and imports have taken a hit, signaling not only weak global demand but also a lackluster domestic demand. And the data on import demand tells a clear story. The US has been reeling back its appetite for imports since February. Notably, India's other major export destinations like China, Europe, Japan, Korea have also shown a diminishing interest in imports, which directly reflects on our merchandise export data. Interestingly, even though there's a shadow over our trade figures, there's a glimmer of improvement in the trade deficit, which has managed to slightly shrink to $20.7 billion. Now, a trade deficit, as we all know, arises when a country's import of goods and services exceeds its exports. India's trade deficit shrank to $20.7 billion, mainly due to a dip in the oil exports, as non-oil and non-gold exports have managed to hold their ground. So let's sum up the key takeaways here. It's quite evident from this data that India's merchandise exports are being held back due to a myriad of factors, including the sluggishness in major economies stemming from the Russia-Ukraine conflict and the surge in energy and other commodity costs, inflationary concerns, and the tightening of monetary policies in key economies. Having said that, our export figures are actually falling in line with the global trade sentiments, as this year is expected to witness slow growth burdened by the ripple effect of the Ukraine conflict, high inflation, the tightening of monetary policies, and the overarching uncertainty in the financial markets globally. In fact, the World Trade Organization has projected a meager 1.7% trade growth for 2023 in its April forecast. Now, this prediction saw a slight boost after China eased its COVID-19 restrictions, leading to an anticipated surge in consumer demand within the country and subsequently bolstering international trade. However, it's important to note that China's growth is currently declining. While India might stand to gain as an alternative trade option, any disruptions that hit China could very well have ripple effects across our shores as well. Now, amidst these short-term challenges, we can't overlook the potential long-term benefits. Initiatives like the production-linked incentive scheme and the Make in India campaign, combined with the shifting demand away from China and the robustness of our service industries, are poised to play a significant role in boosting India's exports down the road. Now, in a resounding display of progress, the Union Cabinet recently launched a series of initiatives focusing on transportation and digital advancements. Now, with substantial financial support, these initiatives combine to reach a total investment of 1.18 lakh crore rupees, showing a strong commitment to creating a future filled with better connections and new ideas. Now, this is an important step as the country combines its technological prowess and infrastructural expansion capacities to fuel growth within the economy. And the government has decided to invest 1.18 lakh crores in various projects, which include getting more than 10,000 electric buses for cities, improving the railways, and making the Digital India program bigger. The Vishwakarma scheme, which the Prime Minister Narendra Modi talked about on Independence Day, was also given the thumbs up by the Union Cabinet. Now, this scheme helps artists and craftspeople as well. Now, let's discuss and look at the initiatives and understand their benefits for the economy. First is the PM E-Bus Seva. Now, this scheme has got the highest allocation of 57,613 crores and seeks to enhance green mobility and augment city bus operations. The amount will be spent on buying around 10,000 new electric buses, which will be deployed in 169 cities under the public-private partnership model. Now, the scheme is expected to generate over 45,000 direct jobs. Additionally, infrastructure in 181 cities will be upgraded under green urban mobility initiatives covering multimodal interchange facilities, national common mobility, card-based automated fare collection systems, and the charging infrastructure. The second is the multi-tracking railway project. Now, in a major boost for railway infrastructure, the cabinet approved 7 multi-tracking projects at an estimated cost of 32,500 crore rupees. Now, the union budget this year has envisaged expansion of the railway network. Now, the centre's planned initiatives, which will receive complete funding, aim to enhance current rail capacities, optimize train operations, reduce congestion, and simplify travel and logistics. These endeavors are part of the PM Gati Shakti National Master Plan, which focuses on creating a seamless multimodal connectivity. Additionally, the initiatives will increase the existing network of the Indian Railways by 2,339 kilometers. Next is the PM Vishwakarma scheme. Now, to strengthen and nurture the Guru Shishya tradition among artisans and craftspeople, the cabinet approved the Prime Minister's Vishwakarma scheme with an outlay of around 13,000 crore rupees for a period of 5 years. Now, the scheme will cover 18 traditional trades as of now, such as carpentry, boat making, armorer, blacksmith, hammer and toolkit maker, locksmith, goldsmith, and potter as well. Additionally, the artisans and craftspeople will be provided recognition through PM Vishwakarma certificate and an ID card, a stipend of rupees 500 per day, credit support of rupees 1 lakh in the first tranche and rupees 2 lakhs in the second tranche with a concessional interest rate of only 5%. Moreover, the scheme will further provide skill upgradation, toolkit incentive for digital transactions, and marketing support. The next is Digital India. The cabinet also approved the expansion of the centre's flagship scheme Digital India, launched in 2015 with a financial outlay of 14,903 crores. Now, this aims to scale up digital skilling, cybersecurity, e-governance services, and the development of artificial intelligence. Now, this would include reskilling and upskilling 6,25,000 IT professionals under the Future Skills Prime program, training 2,65,000 people in the information security under the Information Security and Education Awareness Program. Moreover, the government also plans to support 1,200 startups in smaller cities and towns and set up 3 centers of excellence in artificial intelligence on health, agriculture, and sustainable cities. Now, the government had allocated a record capital expenditure budget of rupees 10 lakh crores for FY24, which is a 33% rise from the previous year, with an aim to stimulate economic growth through increased public spending and also to foster private investments. Now, while private investment has picked up in the recent months, there is still a need for the government to support the capex cycle in the economy, and several new schemes are launched keeping this aspect in mind. Now, the government capital expenditure has a strong multiplier effect with major forward linkages to sectors such as real estate, infrastructure and manufacturing, and backward linkages to sectors such as steel and cement. Furthermore, during the first half of FY24, the government aims to prioritize a minimum of 60% of the capital expenditure, specifically in the April to September period. Now, the emphasis on advancing capex in the initial part of the fiscal year is vital for the government's strategy to enhance economic growth and compensate for the delay in the private investments due to the weak global demand, which affects the export markets, which was discussed a little while earlier. Now, with an unprecedented budget allocated for capital expenditure, the government's efforts are expected to have a widespread impact across various industries, fostering growth not only in infrastructure but also in real estate, manufacturing, and many other sectors. As the government focuses on prioritizing upfront capex to stimulate growth, it skillfully balances public investment and private enterprise, presenting a promising and an optimistic outlook for India's advancement. Now, to conclude, while the inflation may seem too high for a particular month and the export numbers may seem to be under stress, it is quite evident that the government is taking adequate measures to front load capital expenditure and boost growth at a time when the global economies are facing multiple challenges. It suffices to say that these steps will continue to help India remain the beacon of growth during testing times for other global economies. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.